Smart money added exposure again this week. My primary gold bias remains aggressively bullish, but the real opportunity requires patience. It only appears after a liquidity sweep. Let me show you what institutions are actually positioning for.
The weekly bias is completely bullish. Our ultimate objective is the 4650 to 4700 expansion zone, but institutions rarely buy at market price. They require a massive liquidity purge first. Based on current liquidity conditions, institutions are setting a trap. Retail traders are blindly buying the breakout at 4604. But here's what most traders are missing. Smart money intends to hunt those stop losses resting below 4580. Understanding this exact maneuver saves you from becoming retail liquidity. The disaggregated COT report reveals a stark reality. Managed money accounts represent major hedge funds. They actively added fresh long positions this week. At the same time, they aggressively covered their remaining shorts.
What does this positioning actually reveal? Well, commercials are actively absorbing physical supply, swap dealers are expanding to provide necessary liquidity, and managed money is driving the structural trend higher. There's absolutely zero institutional short-side conviction on COMEX right now. The paper trail is completely one-sided. But what's driving this massive capital rotation? The macroeconomic flow reveals a drastic shift. We're seeing a major change in institutional risk appetite. This is a massive flight to hard assets. Notice the aggressive equity sell-off. The Nikkei dropped heavily and the S&P 500 bled out. Meanwhile, Bitcoin and gold surged. Capital is fleeing paper assets for pure wealth preservation. The currency market confirms this institutional flow. Non-commercial speculators are liquidating US dollar longs. The dollar index took a heady hit last week. This removes currency drag completely. It acts as a massive fundamental tailwind for physical gold. The macro and COT data are firmly bullish, but timing the entry requires exact precision. Most traders will focus on price. Smart money focuses on liquidity. Mapping the daily market structure reveals an impulsive bullish expansion. Notice the aggressive series of higher highs. The broad momentum framework is completely intact. This establishes a major fresh demand zone down at 4,500. Now let's zoom into the 4-hour chart. This is where institutions may be setting a trap. Notice the obvious swing lows at 4,580. Sell-side liquidity is resting heavily right there, and it sits directly above a critical fair value gap. This is the exact sequence institutions use to trap retail liquidity. First, they induce retail longs on a high time frame breakout. Next, they crash the price to sweep stops below 4580. This mitigates the 4-hour order block. Finally, they expand aggressively toward 4700. All evidence perfectly aligns with this specific discount entry. The primary execution zone is 4550 to 4570. The stop loss rests safely at 4525. Target 1 is the recent high at 4605. Target 2 is the major expansion level at 4650. And target 3 is 4700. A daily close below 4500 entirely invalidates this bullish bias. The trap is set. The liquidity is clearly marked. Will you be the one buying the breakout, or will you wait in the shadows with the institutions? If you enjoy institutional gold analysis using smart money concepts, subscribe to ICT Market Theory. Leave a comment with your weekly gold bias. And if you want to follow future opportunities, check the pinned comment below. You will find the trading account link right there.